Most Americans are obsessed with the Fed, but the real threat to your savings isn't in Washington. It's sitting 6,000 miles away in Tokyo, and it's about to detonate right now. For decades, Japan has been the quiet backbone of the American empire. They have acted as the world's largest piggy bank, but that bank is closing its doors. As we sit here in 2026, that piggy bank hasn't just run dry. It's turned into a financial wrecking ball. The Japanese debt bomb is no longer a theoretical risk. It is a mathematical certainty. With a debt-to-GDP ratio hovering near a staggering 250%, the Bank of Japan has run out of road. Their struggle to maintain the yen is forcing them to do the one thing the U.S. Treasury fears most. That one thing is total liquidation of their American assets. We are talking about the potential dumping of over $1.1 trillion in U.S. debt. If you think inflation was bad before, you haven't seen anything yet. The largest foreign holder of the dollar is about to hit the sell button. Subscribe call. Before we dive deeper, hit that subscribe button and turn on notifications. This crisis is moving fast, and you cannot afford to be behind the curve. Comment call. Comment below. Do you think the US dollar is still a safe haven? Stick around until the end, because I'll show you the indicators proving the wrecking ball is already swinging. Let's get into the hard facts regarding the yield curve trap. For years, the Bank of Japan, led by Governor Kazuo Ueda, kept interest rates at zero. They even dipped into negative territory to keep their massive debt manageable. But in early 2026, the dam finally broke under the pressure of global inflation. Inflation in Japan has stayed stubbornly above target, forcing the BOJ to hike rates. Here is the shocker. Every time Japan raises rates by a fraction, their servicing cost explodes. We are talking about interest payments projected to double by 2031. To pay for this massive bill, Japan needs immediate cash. And where exactly is that cash parked? It's in U.S. Treasuries. As Japanese yields rise, domestic investors in Tokyo no longer need to send money to America. They are bringing their trillions back home to support their own economy. This capital flight is the invisible vacuum sucking the life out of the U.S. dollar. Why should an American family in Ohio or Florida care about a bond auction in Tokyo? Because the U.S. government relies on Japan to buy our debt so we can keep spending. If Japan stops buying, or worse, starts selling, the supply of U.S. bonds skyrockets. Simultaneously, the demand for those bonds craters globally. Basic economics tells us exactly what happens next in this scenario. Interest rates in the U.S. have to surge to attract any new buyers. This means your mortgage rates and your car loans are dictated by Tokyo's survival. Your credit card interest is now being decided by the Japanese Ministry of Finance. We are seeing the 10-year Treasury yield touch levels not seen since 1998. The One Big Beautiful Bill Act was supposed to stabilize the American economy, but it didn't account for a total withdrawal of Japanese support for our debt. The real shock isn't just that they are selling, it's the desperation behind it. They aren't just trying to balance books, they are fighting a currency war. They must prevent the yen from entering a state of total hyper-devaluation. This is a life or death moment for the world's third largest economy. In this game of survival, the US dollar is simply the collateral damage. Japan's debt is currently 255% of their GDP, which is twice the level of the US. For years, they survived because they owned their own debt, but that's changing. Foreigners are starting to short the Japanese bond market. This puts the Bank of Japan in a corner they cannot escape from. If they keep rates low, the yen dies. If they raise rates, the government goes bankrupt. Either way, they have to sell their U.S. Treasury holdings to survive. When $1.1 trillion hits the market, the price of bonds will collapse. When bond prices collapse, yields and your borrowing costs go to the moon. Most Americans believe the Federal Reserve is the only player that matters. That is a dangerous and costly misconception in 2026. The liquidity of the global system is anchored in the yen carry trade. For 20 years, the world borrowed cheap yen to buy expensive dollars. That trade is now unwinding with violent force. This is the definition of a global margin call. It triggers a sell-off in every asset class, from stocks to crypto. The dollar is being squeezed from both sides by a lack of buyers. We are seeing a structural breakdown in the petrodollar recycling system. Japan was the most reliable partner in that system. Now that partner is being forced to prioritize its own citizens over the Fed. Think about the impact on the American housing market. If the 10-year yield hits 6% because of Japan, mortgage rates hit 9%, that effectively freezes the U.S. real estate market overnight. It stops the movement of capital and halts consumer spending. This isn't a soft landing scenario, it's a hard collision. Real-time data from the Tokyo Stock Exchange shows massive outflows. These outflows are moving directly into Japanese government bonds. This confirms that the repatriation of capital is already underway. This is why the U.S. Treasury is suddenly holding emergency meetings. They know that without Japan, the US deficit becomes unsustainable. We are currently adding $1 trillion to our debt every 100 days. We need a buyer for that debt, and Japan was our buyer number one. If they switch to seller number one, the math simply stops working. It leads to a scenario called fiscal dominance. This is where the Fed is forced to print money just to pay interest. That is the final stage before a currency loses its reserve status. History shows that no empire survives the debasement of its currency. Japan is just the first domino in a global sovereign debt crisis. The shockwaves will be felt in every 401k and savings account in America. You're seeing the end of the post-war financial order. The relationship between the dollar and the yen was the foundation of that order. That foundation is now riddled with cracks that cannot be filled. Keep a close eye on the JPY or USD exchange rate this week. If it breaks the 160 level again, the BOJ will have to liquidate more treasuries. Every intervention they make is a withdrawal from the American economy. This is the hidden tax that is going to wreck the dollar's purchasing power. Financial experts who are paying attention are already hedging. They are moving into assets that cannot be printed or liquidated by a foreign central bank. The window of opportunity to prepare is closing as we speak. We are moving from a world of infinite liquidity to infinite risk. Stay tuned for part 2, where I reveal the exact timeline of this collapse. Now that we've established why the fuse was lit, let's look at the explosion itself. The global financial system is built on a house of cards called the yen carry trade. For decades, investors borrowed yen at 0% interest to buy higher-yielding American assets. This massive wall of money propped up the S&P 500, U.S. real estate, and tech startups. But as Japan hikes rates to save their currency, that free money is being called home. We are witnessing the largest margin call in the history of modern finance. As the carry trade unwinds, trillions of dollars are being sucked out of U.S. markets. This isn't a slow leak. It's a high-pressure pipe bursting in the basement of Wall Street. When Japanese institutions sell U.S. stocks to cover their yen debts, prices plummet. This creates a feedback loop that destroys the value of your 401k and retirement funds. Think about the scale. Japan's pension fund is one of the largest in the world. If they decide to shift just 10% of their allocation back to Tokyo, it's a $150 billion hit. That kind of selling pressure overwhelms any buy the dip mentality. Meanwhile, the U.S. Federal Reserve is stuck in a no-win situation. If the Fed cuts rates to save the stock market, the dollar loses even more value. If they keep rates high to fight inflation, the interest on our own $34 trillion debt becomes lethal. This is the debt trap that happens when two superpowers share a broken balance sheet. Japan's 250% debt-to-GDP ratio is a mirror of where America is heading. We are seeing a race to the bottom between the yen and the dollar. But in a race to the bottom, the world's reserve currency has the furthest to fall. Now let's look at the One Big Beautiful Bill Act and why it failed to stop this. Government spending in the U.S. is currently at wartime levels without a war. This requires a constant stream of foreign buyers for our treasury bills. With Japan exiting the market, we are losing our most reliable lender of last resort. China has already been reducing its U.S. debt holdings for years. If Japan follows suit, the U.S. Treasury will have to host auctions where nobody shows up. When an auction fails, the interest rate must spike instantly to attract any interest. Imagine the 10-year Treasury yield jumping from 4% to 7% in a single week. That would essentially end the American dream of homeownership for a generation. Mortgage rates would skyrocket to levels not seen since the Volcker era of the 1980s. But unlike the 80s, our total debt load is now 10 times larger. We cannot afford 8% or 9% interest rates without the government going insolvent. This forces the Federal Reserve to step in and engage in yield curve control themselves. Yield curve control is just a fancy term for printing money to buy your own debt. This is the exact policy that led to Japan's current lost decades. It's a recipe for permanent stagflation, low growth mixed with high prices. For the American consumer, this means the cost of living crisis is here to stay. Your purchasing power is being liquidated to save the banking system. Tokyo is already seeing the effects. The price of imported fuel and food is surging. Because the U.S. imports so much, a weaker dollar means imported inflation. Every product that comes on a ship will cost 20% more by next year. This isn't just a theory. Look at the price of gold and silver in 2026. Central banks are loading up on real assets because they know the paper system is failing. They are trading their dollars for gold at the fastest rate in 50 years. Japan's move is the checkmate move in this global chess game. They are choosing to save their society and their elders over the U.S. bond market. You cannot blame them. A country must put its own survival first. But the consequence for America is a sudden loss of exorbitant privilege. The privilege of printing money and having the world buy it is disappearing. We are moving toward a multipolar financial world. In this new world, the dollar is just another currency, not the king. The Japan bomb is the catalyst that accelerates this transition. Watch the Bank of Japan's emergency interventions very closely. Every time they spend billions to prop up the yen, they are selling your future. They are dumping the very bonds that keep our interest rates low. This is why you see volatility in the bond market that looks like a penny stock. The safe haven of U.S. Treasuries is no longer safe. Institutional investors are starting to realize that the return of their money is more important than the return on it. This leads to a flight to quality, but quality isn't paper anymore. Quality is now defined as anything that cannot be devalued by a central bank printer. We are seeing a massive shift into commodities, energy, and decentralized finance. The 2026 debt reset will be remembered as the moment the West had to pay the bill. For 30 years, we lived on the credit card of the East. Japan provided the labor and the capital, and we provided the consumption. That deal is officially over because the math no longer supports it. As a finance expert, I see the warning lights flashing red across every dashboard. The liquidity dry-up is starting in the shadow banking sector. This is where the first cracks always appear before a major crash. When the big Japanese banks stopped lending to U.S. hedge funds, the music stops. Without that leverage, the stock market becomes a hollow shell. We could see a 30% correction just from the withdrawal of Japanese yen liquidity. This isn't fear-mongering, it's a sober analysis of capital flows. Money goes where it is treated best, and right now it's being treated poorly in the dollar. The real yield in America is turning negative when you account for true inflation. Investors aren't stupid. They are moving to where the value is protected. If you are holding 100% of your wealth in USD-denominated bank accounts, you're at risk. The Japan wrecking ball is designed to smash the complacency of the American investor. We have been spoiled by a 40-year bull market in bonds that is now dead. The trend has reversed, and the momentum is now toward higher rates and lower currency value. It's time to rethink everything you know about safe investing. Diversification now means moving outside of the traditional fiat system. Look at what the smart money is doing, not what the news is saying. They are quietly exiting the dollar and entering hard money positions. Japan is the signal that the game has changed forever. The debt bomb has a very long fuse, but we are at the final inch. When the explosion happens, it will be fast, violent, and permanent. There is no reset button that can put the $300 trillion of global debt back in the box. We are entering the era of the great devaluation. Your goal now should be preservation of purchasing power, not just gains. This is the most important financial shift of our lifetime. Don't let the normalcy bias blind you to the reality of the data. The numbers don't lie, even if the politicians do. Japan is the canary in the coal mine, and the canary has stopped singing. Prepare your portfolio, prepare your mindset, and prepare for a new economic reality. The dollar's reign is being challenged by math, and math always wins in the end.